Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome back to another episode of Equity Mates, a podcast that explores what's possible in the world of investing. If you've just joined us for the first time, a massive welcome. We have a huge show today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
Bryce, I'm feeling a little bit vulnerable today.
Why?
Now, for people watching on YouTube, and if you're not watching on YouTube,
Watch.
Yeah, we have a YouTube channel, FYI. We have switched our studio back. We're back in these red leather chairs.
Hard to keep up with what's going on.
Yeah, we're trying to get it right. And one piece of feedback we got from early YouTube views was stop wearing shorts on the leather chairs. And I've come in today, completely forgot that we were back to the chairs, and I'm wearing shorts.
We've got the shorts, we've got the lappies on, I've got the jeans on.
You're in jeans, so you got the memo, but I didn't. So if you want to see a little bit too much of my legs, head over to youtube.com/equitymates.
That's it. But we have a massive show today, so we're going to kick off with some news headlines. RBA, Woolworths, Disney and Boeing. We've got Pimp My Portfolio and stocks that we wish we'd bought about 12 months ago.
I've got a Boeing joke for you.
I bet it's not funny.
Why is it called Boeing?
Boing.
Yeah, that's the sound the wheel makes when it hits the ground.
Yes.
News and markets.
Let's start with news. We've got a couple of headlines that we just want to touch on because there's been so much happening of late. And we start with the RBA because last Tuesday, the RBA met for their one of 8 meetings this year to decide what happens with interest rates. And for mortgage holders, the good news is that they decided to hold rates where they are.
Yeah, well, good news for some. I think some mortgage holders were hoping/expecting a cut.
Oh, so maybe dreaming if you're expecting a cut.
I think it was largely unsurprising. 4.35% is where it stayed. I don't think that anyone really expected anything different. The question is really what comes next. And this is a quote from the RBA board after their results. So, recent data indicate that while inflation is easing, it is doing so more slowly than previously expected and remains high. The board expects that it will be some time yet before inflation is sustainably in the target range and will remain vigilant to upside risks. The path of interest rates that will best ensure that inflation returns to target in a reasonable time frame remains uncertain, and the board is not ruling anything in or out. Now, did you like my little emphasis added at part of those quotes?
Yes.
part of that quote. Basically, reading between the lines, they're saying they're not ruling out another move up.
Yeah.
And if inflation stays stubbornly above the target range of 2 to 3%, there's going to be more rate rises.
Yes. Well, this whole time, so many commentators, well, not so many, but a number of commentators have suggested it needs to get to the 5s to get inflation back to where it should be. So time will only tell. But yeah, certainly no rate cuts for now.
Yeah.
Next one, Ren. Woolworths.
Yep.
They can't stay out of the headlines. They can't stay out of the headlines. They may be heading towards a 4-day work week.
Yes, exciting news, but temper your expectation, Bryce's former colleagues, because of the 150,000 rough employees at Woolworths, it may only benefit 14,000 of you.
Okay, so that 14,000... are they in stores? Are they at what they call the Ivory Tower?
Is that what they call it?
No, they don't call it that. The stores call it.
The Coles suppliers used to call Coles head office Battleship Galactica or something like that. Some ominous spaceship reference.
Yeah.
Anyway, different story. So the story here is that the Shoppies Union, one of the main unions that represent Woolies workers,
powerful.
They have approved. So Woolies is renegotiating the enterprise bargaining agreement with mainly the store employees that are covered by these unions. They've approved a proposal for a 4-day work week. Now, the details on the 4-day work week is full-time store employees generally will have a 5-day roster with 38 hours working.
Full-time, normal hours.
Full-time.
Yeah.
And basically this proposal is rather than doing 38 hours over 5 days, you can do 38 hours over 4 days, which is like a 9.5-hour day, 4 days a week.
Yeah. But hot inside tip, they're doing that anyway.
Oh, I mean, store employees,
hard.
Department managers.
Oh my goodness.
No one was working an 8-hour day.
No way. No way.
Yeah.
12 minimum.
It was brutal. I just remember when I first, because when you start, so I was at Coles, Bryce was at Woolies, for people who are new to Equity Mates, welcome. And I just remember when you start at these companies, you start in store to get a sense of it. Yeah. And like bakery managers coming in on days off to check that the shelves were fully stocked, and like it was brutal.
Yeah. And this probably won't help the conversation around profiteering, but like the constant battle between trying to improve efficiency in stores and essentially reduce cost, i.e. labour dollars, and the expectation of what is then produced by stores going up. It was a very tough environment for these guys. So this is one I'll be interested to watch as well, but only 14-ish thousand of the hunt, so about 10% of the workforce.
Yeah.
Next one, Disney earnings. Are they back?
Well, so it's earnings season, as we've covered on the podcast, and there's been a number of surprises, but perhaps the biggest surprise is that Disney Plus, the streaming service, turned a profit.
Yeah. What the hell?
Insert cheering noise here.
Disney Plus being the streaming service.
Yes. Disney Plus being the streaming service that I'm binging at the moment because of Shogun.
Yeah, I really want to watch
Highly
it.
recommend. Yeah. So Disney Plus, for reference, makes about $20 billion a year in revenue, but all of that revenue is unprofitable. Disney has burnt a lot of money on this streaming platform, and people were starting to ask what the long-term vision is. We don't have a good answer on what Disney looks like post this transition out of the cable business and into the digital age. Parks.
I'm telling you.
Star Wars cruises. But Disney Plus itself turned a profit. Now, the overall digital entertainment streaming division did not turn a profit. That includes like ESPN Plus and a few other streaming services. But Disney Plus itself turned a profit, which is really exciting. But there is a but.
The stock dropped.
The stock dropped 8%.
Yeah, it's nuts. It's like, come on, guys. What more can they do? They can do a fair bit more.
They can actually turn a profit across their whole business.
Yeah, but I mean, come on. This is a business that has been leaking serious amounts, or I guess a division of a larger.
Yeah. So I should be clear. Business. They always turn a profit, but that division.
Yeah. So it's like, oh, come on.
Yeah.
What were they expecting? That's what it's saying to me. It's like the market was obviously expecting this to happen then if the stock drops 10%. On the back of it, like what I'd love to know what they were wanting to actually see.
I mean, the market's always future looking, and the future for Disney is what are they going to do with their sports channels? What are they going to do with their legacy cable business? What's the future of Disney Plus? Like, there's still all those questions still remain. Yeah.
But then finally, you made a Boeing joke, so we've got to talk about Boeing. More bad news continues.
Yeah, so
it's not good.
Boeing is preparing to send their first manned space flight to the International Space Station. They have...
Surely it's going to be empty.
Well, no, it's manned.
Who's going to go in it?
I know. I read the headline and I was like, Boeing.
This is not the way to turn around.
So they are competing... Because they've been like an aeronautics contractor for the government for decades. And like before SpaceX and Blue Origin came along, they were like the big boys in the room, but they've just been completely usurped by these upstarts. As much as you can call a $100 billion company an upstart. But they have got a new space vehicle, the Starliner, and they were preparing to send its first manned flight to the International Space Station, but it's Boeing, so no surprises here. They had to push it back, I think because there was some questions.
Just focus on the here and now. Why do they need to do it?
Well, look, when we're recording this, the space flight hasn't happened. I think by the time it's released, it will have happened. So you'll be able to Google and see if it did go or it got pushed back again.
Unbelievable.
But that's not the only Boeing headline. On Wednesday of last week, a Boeing cargo plane, it was a FedEx plane, but it was Boeing, taking off from Paris, landing in Istanbul, had to radio air traffic control and tell the Istanbul airport that they were landing without a front landing gear.
Oh, landing gear. Okay,
Yeah.
as in a front wheel.
I think that's what it is.
landing gears are your wheels.
Yeah. No casualties, but not
Oh
great.
my goodness.
Yeah.
They cannot. There's probably they just need to do a full recall. All Boeing planes.
You can't do that.
They have
that's
to.
like half of planes in existence.
That's who cares.
Every airline.
This business is crashing into the ground, literally.
Yeah.
Anyway,
So look, Boeing has a lot of problems.
a lot of problems.
Yeah.
New CEO coming in. You wouldn't want that CEO job.
Now we have a team member here, Simon, who's calling himself Mr.
Beat Up.
Mr. Beat Down, because he thinks he's got a knack of picking stocks that are right for rebound. He called the Tesla rebound recently. Back in 2022, he called the Meta rebound. So look, he's got some runs on the board, and we keep checking in with him on Boeing, and he keeps saying not yet.
Not yet.
Not yet.
There feels like I feel like there's more to go.
Maybe we'll have to get him on the pod at some point when he thinks it's time.
Yes. Anyway, to keep up with more news headlines and what we're reading, make sure you subscribe to our weekly email. You can go to our website, equitymates.com, and there's a link on the top right corner. We'll also put a link in the show notes to sign up to our email to stay up to date, because there is plenty happening. But Ren, let's move to Pimp My Portfolio.
This is Pimp My Portfolio. Pimp My Portfolio.
That's right. We are back with Pimp My Portfolio, where you get the opportunity to submit your portfolio for our expert to give a few ideas on how it could be better. Luke Laretive from Seneca is with us in the studio. Luke, how are you?
Bryce, how are you?
I'm well.
Ren?
There was less enthusiasm for me there.
Always anticlimactic when I run the prize.
And we have with us an Equity Mates community member who has submitted his portfolio today. Jeff, welcome.
Thanks, guys. Yeah, thanks for having me on.
No worries. We're excited for this one. So, Ren, as always, do you want to give us a bit of high level on Jeff's portfolio?
Yeah, for sure. So one thing that I like about Jeff's portfolio is he's done the work for us and split it into core, growth, and speculative. So to start with the core, about 60% of money is in the core. There's some ETFs, the NASDAQ 100 ETF, VanEck Morningstar Wide Moat ETF, iShares Global Healthcare ETF. And then there are also some individual stocks, Alphabet, ResMed, Macquarie, NVIDIA, JB Hi-Fi. So that's the core portfolio. Then we've got growth, which is a number of individual stock names. We've got Kogan, we've got WiseTech, we've got Netflix. And then finally, the speculative part of the portfolio. Growth is 23% of assets. And then finally, the speculative part, there's some small caps in there, but it is headlined by 2% in Bitcoin. Jeff, is that a fair summary of your portfolio? And maybe tell us how you've thought about building it.
Yeah, for sure. No, that's mostly a fair summary. Yeah, pretty much tried to have sort of relevant weightings between the core, growth and spec. And I guess depending on who you are, you could look at those things differently. Because obviously there's some smaller companies that I've put in core and some big ones down in speculative. But I guess overall how I make that distinction is based a lot on my own understanding and confidence in those. So something like a JB Hi-Fi I have put in the core just because it trades on a pretty low valuation, has a solid dividend, is unlikely to jump around too much. Whereas if it's something I don't understand super well, but I've got a little bit of interest in, I might just take a small weighting, put it in speculative, and then potentially if I start to understand a little bit more or get to know it over time, I might add to that position and bump it up the line a little bit.
Nice. Well, that all makes sense. Luke, what you come up with a nickname for each portfolio. So let's start with the nickname and then get some thoughts.
So the nickname here is Ride the Momentum, or the Momo.
Nice.
It's because there's a lot of kind of what I would call momentum names in this portfolio. Not necessarily that any of them are particularly, there's a few, but not particularly bad businesses or things that I wouldn't own. But more so just how the portfolio is constructed. It's interesting how Jeff has described his portfolio. Like the first thing I did when I got this stripped back spreadsheet, which is just the codes and the weights essentially, I just deleted all the commentary around it and just sorted by largest weight to smallest weight, because that to me tells me everything I need to know.
You're not worried about the core, growth, speculative?
I think it's a bit of an accounting bias type sort of, mental accounting type sort of thing. So that's where I sort of, get down and dirty with it. I'd like to ask you, Jeff, maybe just because you pointed it out, and you can just tell me we can do something else, it's no big deal, but talk me through how you value and think about owning shares in JB Hi-Fi. It's just a good one because I know it backwards, and I just want to hear, I suppose, some of the thought process you have and of why you bought that stock, why you continue to hold it, and why you sort of think about it as so confidently in your core.
Yeah, absolutely. That's a relatively new one. So the portfolio overall, I've been at it for about 9 years. So you can see some of them have been held there pretty much the entire time, but JB I've only had about 6 months. Picked it up, was having a look through the financials, and basically it was trading on a PE of around 9, I think, when I bought it, which I thought seemed like a absolute bargain. And when I looked at the revenue line, I thought, it's continuing to go revenue, pays a dividend, it's not going away anytime soon. My own experience with going there seems like it felt like it was a bit priced for, like, it didn't have much of a future, but I felt differently. So I thought, I'm happy to have a bit of a look, and started building a position and reading up on it a bit more, and started to be a bit comfy.
What do you read, Jeff? What's your sort of your sources of information?
Usually I'll start looking through, I'll just on my Westpac account, I can look through the financials, starting with the data, starting with the numbers. I don't like if there's lots of debt, those types of factors. So it's generally where I'll start.
Yep.
If I think the numbers start to look all right, I'll generally then go out on the internet and see which commentators have written about it, and obviously that's a pretty wide universe, but I'll read anything I can find. So I don't remember specifically what I read for JB.
No, it's more just getting a feel for what you're doing. I'm not sort of trying to pick on JB, I'm just using it as a bit of a case study. Do you know what I mean?
Yeah, no, that's fair. And then obviously I'll look through the company announcements and shareholder presentations as well. That's basically an overview of how I get there.
Yeah, cool. Okay, so I'm just looking at, I just quickly pulled up my fact set here and just had a look at the JB Hi-Fi PE. I haven't checked it for a week or two, but I haven't seen it on 9 since like the bottom of 22. It was on 10. I don't know whether you're looking at last 12 months, but that would be my one, I suppose, way to level up your game. And I've said this to a number of people, is improve the data sets that you look at and the data that you're actually using. So looking at last 12 months earnings and historical financials and all that, that's all great. But, in my experience, there's limited alpha and limited opportunity for outperformance in historical data. It's often pretty well priced, particularly in a large cap like JB Hi-Fi, which has got, 12 analysts who are covering it, day in, day out. I would say that forward data is where the value is, the uncertain period, the future. And, the quick sort of analogy I use is you need to understand what everybody else knows, what you know, and where the difference is. And that's kind of how you find opportunities in the market, and how to exploit that difference is kind of the unique thing. Not that you're the only person who needs to know that, but it might only be a small subset of the market who thinks that particular way about that particular stock. Well, I get JBs on 16 and a half times consensus earnings at the moment versus the 5-year average PE of 14 times. So I don't think there's any objective measure that could say that JBs is cheap if you're just looking at pure valuation at the moment. I certainly see more concerns around household discretionary spend going forward. I think we're in a higher interest rate environment for longer. JB's been really good at resiliently riding that at the moment, but I don't know how long that lasts, and JB is not the only one in that boat. But look, that's sort of more by the by, but just to give you some sort of context, I suppose, around that. I don't have any particular issues with the portfolio. I just would like to see a bit more diversification. I'd like to see some sourcing returns from things sort of outside tech and healthcare kind of more broadly, which obviously are great places to invest. I've got no particular negativity around them. I'd just like to see some value, value ideas, some property REITs, some infrastructure. Like, there's lots of good places to invest, and that doesn't all have to be in one sector or in kind of one corner of the market or two corners of the market. So that'd be my initial kind of comments. I think you could do, like I said, with better data and a little bit more work. Your portfolio is expensive on the whole if you're just looking at aggregate. I mean, of the profitable stocks that you own, they're roughly on 41 times earnings on average. The S&P's on 21 times and the ASX 300's on 17 times, just for context. So buying high PE stocks isn't necessarily a problem, but it's just something to be aware of, I suppose. And just to think about that, a story and recent positive returns doesn't make a good investment. That's not how it works. So that'd be sort of my comments. But mate, overall, you pick some good stocks, sounds like you've got a bit of process, sounds like you're looking at valuations, you're reading, and you could just do with, like I said, levelling up the data and levelling up the quality of the stuff that you read to help you become, take your investment returns to the next level.
I think one thing that we may have brushed over there, jumping straight into the individual stocks, is it's all good. But it sounds like the structure is all there, sort of like 60% core, 20% growth, 10% speculative. Like that seems okay. The 25 positions, like that seems like an okay number. Like the building blocks are there, and then it's just about
you're building it, what blocks they are. It's kind of what I'm more interested in this one. I think Jeff's got a pretty clear idea from what I can see here of how he wants to run his money, and that's fine. I'm not here to tell people that they should do this or do that. I think what's important, though, is that it makes sense, and maybe that core, like I said, could look a bit more like a core, traditional core, in the sense that you're getting returns from a range of sources that aren't just the top 100 companies on the the NASDAQ and doubled up with Google, and then doubled up with Moat, which is kind of biased to these businesses that have high ROE and low debt. Well, that's often these SaaS mega companies and mega tech companies too. So I would be cautious on that. Would it be my ideal core? No. If it's yours, then that's fine also, Jeff. And then just on the stocks, I think you need to have, and I know people want to hold stocks for a long time and that, but I'm big on valuation. I'm big on having valuation discipline, and I think the names aren't bad, but they're not necessarily the best buys that you can get on the market at the moment, that's for sure.
Nice. Well, we have unfortunately run out of time, but Jeff, I hope you've been able to get something out of that. Did you have any final question for Luke?
Yeah, no, that's great. Thanks, Luke. Appreciate you taking a look. It's obviously been a pretty hot run for tech over the last little while, so quite a lot of them have run a fair way, and there's a fair bit of unrealised gain. So I guess I'm just a bit reluctant to chop and change it because I know that I'm in for a big tax bill. So there's some positions that I either like to reduce or eliminate, but know that they come with a big bill. So I'm just holding them for now.
Mate, paying tax is a good problem to have, right? And crystallising gains, I know people are reluctant. You get your discount. I think if you're not investing in a tax-effective way and you haven't got the right sort of structures, I think that's a really good minute to think about, okay, well, I'm taking this investing thing pretty seriously. I've got serious money at work here. This matters to me enough that I don't want to pay the tax bill. It shouldn't matter enough for you to go and get some advice. And that's the, that trigger, I think's pretty logical from my perspective. Selling investments, and you're not the only one, the Equity Mates community at large, I think, has this problem. Everyone's good at buying and nobody's got any selling discipline on both sides of the ledger.
When you say investing in a tax-effective way, I know that it's going to be personal to people's tax situation, but are there any general things or vehicles that you're thinking of when you say that?
Everyone's really different, but I mean, I'm talking about super, I'm talking about trusts, I'm talking about, whether it's joint name, your wife's name, your kid, there's lots of things you can do. There's lots of levers you can pull there. Whether it's a charity that you want to, there's lots of things you can do. So let's just maybe table that one.
Yeah.
And, depending on your level of wealth, there's, various things that make sense.
Well, I think that's a perfect segue to say if people want to speak to Luke, they can. You can go to equitymates.com/advice, fill out the form, say you want to speak to Luke, and we can put you in touch.
And as much as Ren likes to whine about my Cayman Islands fund that he thinks I've got running off on the side, there is we're not be sending money.
I was wondering where that was going to go. Well, Jeff, before Luke reveals all of his secrets, we should wrap it there. So a massive thank you for joining us today and sharing your portfolio.
My pleasure. Thanks for having me, guys. It was great.
Head to equitymates.com/advice if you'd like to chat to Luke. Otherwise, equitymates.com/contact if you'd like to submit your portfolio for us to have a look at here on the show. But Luke, as always, absolute pleasure. Thank you very much.
Thanks, Bryce. Thanks, Randy.
This is Pimp My Portfolio. Pimp My Portfolio.
If you'd like to submit to Pimp My Portfolio, head to equitymates.com/contact. All the information is there to submit your portfolio and we will be in touch. We're having a great time doing this segment. But we're going to take a quick break, and on the other side, we're going to take a trip down memory lane and probably get quite annoyed with looking at all of the stocks that we could have made heaps of money on in the past 12 months. We'll be right back. Welcome back to Equity Mates. Ren, the last 12 months.
Well, no, this isn't the last 12 months. This is the last 2 years.
Okay, since the end of 2022.
Yeah.
So what we're about to do is have a look at some of the small tech companies that have recovered in incredible fashion.
This segment is called Well-Known Companies We Wish We Bought in 2022.
Damn it.
There was a passing reference a couple of episodes ago to we should do this segment because some of the rebounds have been pretty incredible.
Yeah.
And so we've done the work and we've had a look at some of those companies and we've got a top 5.
Yeah.
So for context, in the last 12 months, the ASX 200, Australia's top 200 companies, is up 7%. The S&P 500, America's biggest 500 companies, is up 26%.
Okay.
Both not
Pretty
bad.
decent.
Both not bad. Like, especially the S&P 500, you'd be happy with that. But like, just some of the movement. Temple & Webster, the furniture guys, 224%. NVIDIA, 221%. Temple & Webster has outperformed NVIDIA.
Say that again.
Temple & Webster has outperformed NVIDIA.
It's an AI company though, bro.
So is NVIDIA. Just rattle some names off. Groupon, 217%. Drone Shield, 197%. Dell, 185%. Rolls-Royce, 175%. Zip's back, 168% up.
Oh my goodness.
Lyft, 103% up. Adbri, the cement company, doubled in the last year, 100%.
Cement.
Yeah. I think that's to say there's heaps of pockets of opportunity, and like if you're willing to do the work and try and find good opportunities, you can make plenty of money, whatever the market is doing.
Yeah.
But this got us thinking about the last 3 years, really, because from the highs of 2021. The market fell sharply, and I think a lot of people kind of fell out of love with stock picking and they retreated to safety or they left the market altogether. But the market bounced a lot sooner than people thought it did.
Yeah, it caught me by surprise. Yeah, it's kind of like, what is going on?
Well, what is going on is the market massively overreacted in the end of 2021, start of 2022, and we missed a potentially generational buying opportunity in really well-known names.
Yeah. I mean, look, this is not to say that if you hadn't been invested, you've missed. If you've just been invested in the market, you've also done well. So don't take this segment as like you've missed out. But
don't read into this more than it is. It's just like how crazy are some of these numbers.
Well, let's start with some honourable mentions, Ren. Snapchat.
Yeah, so Snap fell 90% and then was up 120%. Meta, not really a small company, but it fell 76%. It lost 3/4 of its value and then up 416% from then.
Yeah, huge.
Netflix, down 75%, then up 247%. These rebounds.
If you think about those two companies as well, even Snap, these were companies that had some bad stories around them and were really sold off.
A lot of questions.
Yeah.
Shopify, down 85%, then up 196%. Like, these rebounds are just incredible. And that's not even our top 5. They're just the honourable mentions.
Let's start with number 5. Coming in is Palantir. So in January 2021 to December 2022, so that almost 12-month period or 2-year period, it was down 82%, got smashed. Since December, it is up 240%.
Number 4 is Duolingo, the language training app. It peaked in December 21, then to December 22, down 66%. Since then, it's up 262%.
Wow. People love language.
No. My theory about Duolingo is it's the same business as gyms. It thrives on aspirational subscriptions.
100%. I could probably name 5 people I know who do that exactly.
Yeah.
Want to learn Italian or going overseas. Need to learn the basics of Italian. Yeah.
Now, the other thing about Duolingo, really good on TikTok.
Is it?
Yeah, really memeified their mascot.
Okay, nice. Coming in at number 3, Spotify peaked in February 2021. It bottomed out in November of 2022, down a whopping 81%. Since then, it is rebounded to the tune of 320%. Wild.
Yeah. Number 2, Coinbase peaked in November 21, down 90% to January 2023. Since then, up 544%.
Unbelievable, yeah. I would say, I'm pretty sure Craig from Crypto Curious podcast said it would be up 1,000% by the end of the year.
Yeah.
Is that right? I think
like something he would
10
say.
bags,
Yeah.
I think he was saying. So he's halfway there. And then coming in at number 1, a roller coaster of a stock.
Oh, God.
This stock peaked in 2021. It then fell to a low in 2022 to the tune of 98.88%. It was down from $361 to $4.
Yeah.
We spoke about this because there are some analysts that completely got this company wrong.
Yeah.
However, it has rebounded 2,780%. Brand, what's the stock?
The stock is Carvana. Now, for people doing that maths in their head, for a stock falling 99% and then rising 2,780% is still about 2/3 down. Like it fell from $361 to $4 and now it's back to $117. So you got to keep that in mind.
Yeah.
A lot of these stories, the companies aren't back to where they were in 2021. Like Duolingo's above where it was, but a lot of the others aren't. But I think my big takeaway from this is, first of all, when times are bad, that's when you've really got an opportunity. But if we look through all the inflection points where all these companies bottomed out, Snap was October 22, Meta was November 22, Netflix June 22, Shopify October 22, Palantir December 22, Duolingo December 22, Spotify November 22, Coinbase January 23, Carvana December 2022. And so I was like, what were we doing in 2022? And like in October 2022, October, November, December, what were we doing? And I was like, well, we were doing FinFest and you were getting married. And so that was really, that distracted us from the generational buying opportunity. But if you think about the market at that time, there's like a delayed effect. Like it's not like in November 2021, people were like, the market's peaked and now it's falling and it's terrible. The euphoria continued well into 2022. That's how we got so many people at FinFest. It was like, people only started realizing in sort of the second half of 2022 that, the market's falling pretty precipitously here. And the first interest rate rise in Australia was in May 2022. So if you think like, even then, like one rate rise, we weren't really talking about inflation and interest rates as a story. It was really only in the back half of 2022 that we were like, this is not great. And people were like, I might be done with investing. I'm losing a bit of money here. And people were panicking and the sentiment really changed. But that was when a lot of these stocks bottomed out.
Yeah.
And 2023 was really the year where people were feeling the pain and the sentiment was really high and everyone was talking about when we were going into recession. But if you look at these companies, and obviously I'm Captain Hindsight here looking back, but the companies had already bottomed out. And it's just such a reminder that like the market is forward looking and the market always overreacts and it overreacts quickly. So the market overreacted quickly on the downside and these companies sold off like 90%. But then they started going again.
Just like it may have overreacted on the upside at the start of this year, though.
Let's not worry about that. But it's just a reminder that like when you're feeling like everything is at its worst, that is probably the moment that you should be checking what's happening in the market.
Yeah, I mean, to be like, I reckon unless you had a list of stocks that you continuously checked, this is where the whole momentum play. If you had some screens set up just to be like, these companies are really hitting their straps.
To be honest, though, it's not like they bounced quickly. They probably didn't have the strongest momentum. A lot of them like traded and like
A 2,780% bounce in 12 months is pretty strong.
okay, yeah, that's fair. That's fair. Yeah.
Even 544%. Coinbase is one that you could probably look at and say, there was an opportunity there regardless with the whole, we know what happens.
The thing that really annoys me is I owned some of these companies pre all of this, but pre 2021 and 2020 as well. Spotify and Shopify, I held all the way through this whole thing.
Yeah.
It's like, why didn't I just put more in? Like, I knew the companies, I believed in the companies.
You mean when it was down?
Yeah. Idiot.
Well, learning for next time.
Assuming there will be a next time.
Yeah, 100% there's going to be a next time.
Yeah.
But that brings us to the end of our show today. If you would like to join the conversation, keep up to date with stocks that we're talking about, stocks that the community are talking about, come and join us in our Facebook discussion group. And if you're loving what we're doing and getting a lot of value out of our show, then we'd really appreciate if you could rate and review through your podcast app. It goes a long way to helping us get in front of new equity mates. But Ren, that's a wrap. Big show today. Loved chatting stocks as always. We'll pick it up next episode.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.